Thank you for watching the Housing Oregon YouTube channel. Please like and subscribe. Slide decks from the presenters are going to be available below. Thanks for watching.
Okay, for our panel, my name is Trell Anderson, and I'm Executive Director of Northwest Housing Alternatives. I'm also a board member. So I've been doing this work for 30 years, and it's always been a challenge. And that challenge is part of what brings us together. It's part of what makes working in this field so exciting for me. We all like to problem solve. We like the challenges. But I have to say, it's never been so hard as it is right now. So that's why I'm really thankful we have this panel. So for the first time, we're publicly using the term troubled affordable housing projects, right? I mean, we'd never wanted to say that out loud, but I'm really glad that we have a cross sector of experts from public funder, private funder, bond counsel, representing project sponsors to really shine some daylight on this. And let's have a real conversation, as some of my colleagues have been saying. It's time for a real conversation about the state of the industry and where things are today. So our moderator this afternoon is Michael Schrader, Senior Counsel with Orrick, Bond Counsel. Our panelist members include Kathy Swift, who's our Senior Vice President and a nonprofit development officer at Heritage Bank. And Kathy also serves on boards of sponsor organizations. So you have that banker side plus, the project owner and sponsor side. Traci Manning is Executive Director of the Housing Development Center. Dunson-Strane is Assistant Director of Production at Oregon Housing and Community Services, and so can speak to us from the funder side of the equation and what you're seeing across the portfolio, across the state. And then Kelly Fisher is an asset manager at Housing Works and can speak to us from really an owner, project sponsor perspective. Thank you all. I think this is a very, very important conversation. Thanks for shining daylight.
Thank you, Trell. It's a pleasure to be here with all of you today. This is a bit of an intimidating room. This is a big room, but absolutely thrilled to be up here with Traci and Kathy and Ty and Kelly. I'm just very pleased that they could participate and share their perspective with you today. We've got a handful of questions. We're going to sort of ping pong it back and forth among the group here, but not overly structured here or script on this. But just to start, just some observations. In our role as bond counsel to OHCS and several local housing authorities, we've been fortunate to be part in the last 3 or 4 years of, I think, more than 80 bond LIHTC financed transactions. Those transactions didn't keep me that busy early in my career, but they sure are keeping me busy now, which is great. Obviously, the gap funding has been huge in terms of really just a game changer in terms of what we're seeing in terms of production, whether it's LIFT or Metro Geo or just a variety of the gap sources we're seeing. We just know how central those are to the production levels that have ramped up over the last few years on this. A few years ago, we would close a bond transaction with cookies at the office. And then we would go to the groundbreaking, and then we'd go to the opening and say, that was great. And after we closed, we'd see a project cost certification to make sure all the bond proceeds were used as they said they were going to be used. And then we went on to the next deal. That's not the world we live in anymore. We see transactions coming back multiple times during construction, during lease-up, and getting to conversion on that. So I don't want to make a pitch for full employment for lawyers, but this has been full employment for lawyers on this. And we're seeing a range of things. We're seeing from we need an extra 6 months for construction, or we need 6 months for lease-up, or any number of things, or we can't get to conversion. We need additional funding. We've got to readjust this or extend this, or we've got a reissuance. So we're seeing a variety of things that are bringing transactions back for a second look or document amendments or adjustment. And I would say, some of the bumps or some of the troubles are minor, some of them are major, and we've seen a whole range of things in our practice on that. There's still good, solid projects, but there's just clearly some dynamics out there that are creating challenges that we didn't have even a few years ago. So I want to start today with that observation that the lawyers are seeing more of the transactions across their lifetime on that. I want to start today and just ask for some general observations from our panelists. So maybe Kathy, we can start with you. And then Kelly, if maybe you can talk about your portfolio, and then Traci, if you could follow up from that. With that, what are you seeing?
Okay. So the world has changed. There are reasons why our world has changed. And I think Trell brought it up. You know, nobody wants to talk about that we'll talk in broad generality, the world has changed, but a lot of it is attributable. And I'll let Traci talk about some of that. But a lot of the deals that got done before the COVID hit were tight, and that 2% revenue growth, 3% expense growth of the pro forma was really related to historically looking back. Yeah, a project with that pro forma will work, but what we really haven't figured through is that was in a period of long-term interest rate decline and flat inflation, and it got upended, and that upending was hidden during the pandemic because of the government money that, you know, really, and as it should have, came in and provided liquidity to the sponsors. And so the sponsors were able to adjust and provide, as well as organizations, OHCS and others did. But overall, sponsors now are running through their liquidity. And there's still a tail of deals that are based on a 2%, 3% pro forma, which will break. And so I think we have to readjust our reality and how we approach projects as they become stressed, and view it more holistically at the sponsor level. How are we getting through this? Then for the boards, how the boards of this nonprofits fully inform them. This is not that management messed up. It's not that every project we did in the last 3 years we did wrong. It's something more than that. So that's the start off. Do you want next?
I think from our perspective as a practitioner on the ground dealing with these issues with Housing Works, I know that we had made the decision during COVID not to increase rents for a couple of years, not realizing how much expenses were going to increase. So we're seeing kind of that double whammy of not keeping up with our rent increases, and then we're seeing our expenses increase exponentially, like I'm sure everybody else is. Between insurance, we've seen over a 60% increase since like 2020. We've had a really tough time securing insurance. We've had carriers just say they're going to drop our properties. They no longer want to do affordable properties, or they don't want to do Oregon because of wildfires. So we've really had to do a lot of shopping around for insurance, shopping around for cost savings, and quite honestly, some deferred maintenance has happened because we haven't been able to cover those costs. So we are seeing some of our properties struggling with cash flow and not meeting our DCR requirements. And add a note in here too with our property management that we've seen, you know, with labor wages, just how much labor wages have increased. They were running 60% staffed for a couple of years, and I think they're finally fully staffed again. And so, you know, there wasn't a large jump because they were doing some of the work with less staff. But when you look at our hourly wages, we were averaging from $20 and now we're probably closer to $28 to $30 to get staff on board to do this work. So it is really hard work, and we're just kind of seeing this perfect storm of it all coming together, of the eviction moratorium and not collecting rents, not doing rent increases, and now, you know, having some deferred maintenance. And so like all this stuff is happening at once. So, you know, I hate to have a problem without a solution, but hopefully with everybody around and all these conversations, we'll start coming up with some good solutions together.
Yeah, thank you. I think putting some of the pieces together, Housing Development Center works primarily with exclusively with nonprofit and affordable housing authority clients. And so, you know, during the last 3 years, we saw some very dramatic increases in construction interest, supply side issues, lease-up issues. And so the result was a need for additional sources. And, you know, the nonprofit sponsors that we work with are used to being, and this is a theme for today, I mean, they're used to being creative and having to hustle. It's not new, but this was really, as we've all said, a whole new level. And so all of us tapped a big chunk of developer fee in order to pay our vendors and meet our responsibilities and meet our commitments. That's what we do. And then for all the reasons that Kelly just shared, you know, people coming out of COVID that couldn't pay rents maybe that weren't increased because we're trying to meet our missions, operating expense escalation, project owners, again, you know, are going to meet their commitments. They're going to pay their vendors. And so they're digging into their reserves. Well, what fills those reserves, in many cases, a pretty big chunk of it is development fee, right? It's there to catch the next project to pay your resident services costs. And so we've tapped developer fee to meet our commitments on the development side, but then we're also not refilling the reserves we're using to meet our commitments on the operating expense side. And so sort of connecting those two dots, I think, is the thing that Charles was referencing, is particularly unique to the time we're living in right now. And then again, watching our partners all also be hit hard, you know, the hiring issues in resident services and supportive services and in property management. So there's the problem.
Okay, so we've done the overview of the gloom and doom. Now we're continuing on the theme from last night. Now we're going to talk about our courageous hope and what we're going to do to figure this out. Kathy, maybe you can start us off here, but what practical advice would you give to project sponsors who are seeing construction delays, projecting funding gaps, extended lease-up, stabilization timeframes, and some level of restructuring to get to conversion?
Yeah. I would say that, and these have happened to me. It's not, you know, I'm not brilliant. It's communication, and it's early communication, and it's not making immediate demand, but learning from the folks at the table. And, you know, that's the equity, that's the OHCS, that's the lender and the sponsor. What can they do? And how are we going to do this together? And something I'm seeing happen, which I think we need to do a much better job of, and I'm there, is talking about how we can get to a solution, not just, I need you to do this. It's, I need to understand what you can and can't do and why, versus the alternative. And then we jerry-rig something. But longer term, we need to fix the systemic problems that have just resulted from this, you know, what I call a black, and others call a black swan event. Our understanding of what can be done is changed. And we can't just always do the new deals in the way we did the old deals. And projects aren't on their own. It's the sponsor and because the sponsor takes on so much of the risk. We've got to look towards the overall health of the sponsor and not just make the demand, oh, we've got an LPA that demands that you have to put this cash in. It's like, no, let's all figure this out.
Yeah, so sticking with the development part of the cycle and the short term, I echo what Kathy said, over communicate with your team and get your whole team to the table. Don't make assumptions that, oh, I need the finance people, I need the design people, I need the construction people. Bring them all to the table because people have ideas and solutions that you may not be aware of. For the staff, you got to project manage the heck out of it. Like, tell your boss, I'm sorry, I'm going to have to drop everything else I'm doing. I need to identify and know where we're at on critical path every minute. Specifically, a moment in time, you cannot oversee lease-up closely enough. Trust and verify, and then maybe verify again. If you have any lease-up reserves in your budget or any operating cash you can spare during lease-up, bring in some help. Lease-ups are really struggling, as you all know, and it's really an important time financially to get your project converted.
Great, thank you. So Ty, you and your friends at Oregon Housing are quite popular right now. And we've seen that securing additional state resources and other local resources is oftentimes key in terms of stabilization to conversion. And on many, certainly of our bond and LIHTC finance projects, and no doubt lots of other projects as well. I think in some of my history working with OHCS, we've seen MCOF, GHAP. We got lots of good acronyms, don't we, Ty? We got Orrick too now. So I think we're working on new ones. So that's great. So MCOF, GHAP, supplemental lift, last gap. Ty, how should sponsors approach OHCS to maximize the prospects for successful supplemental funding? And are you willing to speculate on what the magic money is that's going to be there for everyone in the months to come?
Sure. Yeah. Thanks. Yeah. Well, so just kind of, so I like to talk in sports references, so I'll just kind of indulge. So just kind of go with me. So yeah, I'd say, think of OHC. I mean, if we're building, it is baseball season. So just, my dad played baseball, so he got drafted. So, I mean, you got to go with me on that. So, think of OHCS as just kind of part of your lineup. It's up to you where you want to bat us. I'm not going to play GM, but when you're approaching OHCS and, you're thinking about your lineups, but, I'd say, if you're out talking to the owners of, OHCS, like the elected officials, the governors, probably at least give us 24 hours to, look at a response. This timing wise, I know advocacy is super important, but in critical moments when the deals are, when you're looking at thought partners, the approach is just better, to find an opportunity to have dialogue with OHCS. We want to be a thought partner in problem solving, and even if you're having us pinch hit, pinch run, we don't have to always be like, we're not going to bat leadoff, just FYI, like, you're going to have to talk to your lenders and investors, and and also check your depending on what level of baseball you're at, you're going to maybe have to check some couch cushions in your house to planning wise, so just strategically think about those things, and just we've expanded quite a lot, and for those who don't know their production analysts, make sure you keep those folks in the loop. you know, Hattie Hyatt is also, you know, a part of that lineup. I technically work for her, even org chart wise. Don't let the title fool you. You know, myself, Roberto, we all work for Hattie Hyatt. So you know, if you don't know that name, you're probably going to want to make yourself know that person. Is, you know, she's probably, you know, maybe, you know, at least batting fifth, you know, depending on the day, you know, can pitch and hit. So just, you know, FY, just kind of think about that as far as, you know, game planning. Because, you know, we do want to be partners in this. And we are, you know, it is a you know, budget cycle. And, you know, I think there's going to be good momentum on future resources coming. But the last gap, just kind of leave it, you know, we got to think of a new acronym on last gap, if any, you know, because that is actually ending by the end of the month. So if you had, you know, kind of waiting on those requests, yeah, I would suggest you start to formalize those and get those in sooner than later, because, you know, process-wise, we're going to close the door and switch to the ORCA process that all you folks are, I know, super excited about the ORCA. I know, you know, people are jazzed about that and want to come up with their own acronyms, but, you know, this is the ORCA process. It is what it is, right? So we're moving full steam ahead on that until we're told a different direction. So I think that's it.
Ty, that's great advice. And as having OHS as a client, I'm going to note to run everything through Hattie, which is just really good advice in any event on that. No, I think we've certainly seen in our bond finance projects how critical, whether it's Metro Geo or a supplemental lift or last gap or a couple of years ago MCOF, how absolutely critical those resources are. But I do think that you know, the early notice, everybody leaning in, to Kathy's point, are really critical on that. Kathy, would you like to add to what Ty said about maximizing your prospects for supplemental funding?
Sure. Really, and I'm not 100% sure what you're thinking of, but really, we need to, I guess I'm more focused on, you know, once the deal is done, you know, and we're trying to figure out if there are the shortfalls.
Right. Exactly.
Right? And so really viewing your portfolio holistically, if you're a sponsor, and seeing where something that I've done on some is, and there has been an openness that there might have not been before, for taking the older properties that don't need immediate deferred maintenance. Okay, they've got to be, you know, performing properties, and using some of the other, you know, either financing alternatives of tax exempt financing via SNAP. I know we're talking with OHCS about other kinds of use of private activity bond to get the lower interest rate, but so that you've got the reserves you need to get through this period. And, you know, when I'm underwriting now, and if you didn't attend the senior lender session that was Tuesday morning at 9, go back and read that. We had some of the smartest people, including Traci and Gina Leone, and we really did cover how to handle and how banks and debt funders are viewing your business and the decision-making that they're doing of when they can stretch and when they can't. And the necessity for me to be your advocate in terms of knowing what's going on within your business, all of your business. It can't be just this project anymore. It's got to be systemically or holistically looking at your funding resources.
Thank you, Kathy. Let's pivot for just a minute and talk about asset management. Kelly, you started by mentioning property management costs and then also noted property and casualty insurance. Let's start on the property management side. I know that Housing Works brought property management effectively in-house a number of years ago, but I'd like to hear your thoughts on that.
We did in 2011, Housing Works established Epic Property Management LLC, and the Housing Works staff is the board members of that property management company. So it is a separate entity, but it was created by Housing Works in 2011. And we brought it in-house just because we felt like we weren't getting the level of service or results that we wanted from outsourced property management company. And I would say until COVID hit, it seemed like it was running along pretty smoothly and we were getting pretty good results. I would say that communication is great. We have full access. We both work in Yardi, so we're able to pull up reports and rent rolls and any information that we want on properties at any time. And so that's great. We can get immediate information, vacancies, and so there's never any question about how things are operating or where our properties stand. And we're both very mission driven. Like we're definitely, focused on successfully housing residents, and that's our goal. And we do that really well together. But I would say that just because we created the property management company, we're not isolated from any of the other issues that any of the other property management companies are seeing. And like I said, they were running at 60% staff for a couple of years. And so a lot of things were kind of dropping off the radar. And I know this last year, they've really been spending a lot of time kind of trying to get caught up on recertifications and just, getting out the payment notices, like reminding people like, hey, you have rent to pay. Like you have to pay this every month or you're not going to be able to live in this apartment. So kind of just getting back to the basics and trying to get staff hired. And, I hear that a lot from our team that they really wish that there was like a training track where people could go through property management 101 and come out with a certification and know how to do property management. They spend so much time just trying to train up staff. And for whatever reason, it's a really hard job and there's a lot of turnover. And so it feels like we're constantly hiring and training. So no, I would say we're not isolated from any of those other issues that we're seeing with other property management companies.
And Kelly, I think when we were talking about this panel, you noted that even with significant salary increases, there's still challenges.
Absolutely. Yeah. I think when I was looking, we went from $20 in 2020 to now $28 is kind of our average of what we're seeing for maintenance and property management staff. So, we were hearing that a lot at first that from our general managers, well, we need to pay more. We need to pay more. We need to pay more to get the good hires. And even with paying more, that hasn't really been the solution. So I think a lot of what I hear when I go on site and talk to managers and the maintenance staff is, one is just feeling that they're supported, that they have the training that they need, that they're not out there alone trying to figure these things out. And so training is a big thing, just trying to have the support and the time, like the expectation of what property managers need to do in a day it's a lot. They have it feels like we have increased, I think Traci was saying this with resident services, just the residents. I don't know if you guys are seeing this in your properties, but it just seems like they have a lot more needs than what we had pre-COVID. And, whether it be from hoarding or domestic violence or just mental stability, we're just seeing that they need a lot more assistance. And our community managers really don't have the time with everything else that they're doing to really walk residents through some of those things. And so resident services, I think, is going to be more and more important as we continue this conversation.
Great. Thanks, Kelly. Traci, you noted earlier the lease-up, that you really can't pay too much attention to lease-up, and certainly the HDC team works across a broad range of projects. Do you have some thoughts you'd like to add about property and asset management generally?
Well, I'll save my call to action for that last question. It's right here. Yeah, I think that well, I'll do my asset management call to action now. So we can't put I mean, we all try to and pay lip service to asset management being important, but that's the front line on even finding out what kind of condition your properties are in, right? Like, it takes a while to filter up for you to know. And so the industry just needs to dial up its support of asset management. So where are asset managers in the room? Raising your hands. If you're sitting next to an asset manager and they're not raising their hand, they're also really shy. Would you please nudge them? All right, I know there's more asset managers in the room. Actually, they're all probably all working. So EDs, take everything off of your asset manager's plate. They should not be also organizing events and the food pantry. Check in with them, understand what they're telling you. You should know more about what they know, what is on their desk than knowing what's on your developer's desk. Funders, I did warn Ty I was going to do this. We need asset management fees above the line. We can't pretend anymore that this isn't important. I mean, you can't ask us to help solve these problems and not pay for them. And I guess the other important thing about asset management is all of us, the whole industry, thought it was going to cost less to manage these units than it currently does, whether it was COVID, whether it was I mean, God, we used to like 3-bedroom apartments that we'd put like $3,000 per unit per year in operating costs. We all did that eyes wide open and we thought it would work, and it doesn't work. So it's nobody's fault, right? We all have properties underwater in our portfolio. Everybody does. And so this isn't anybody's fault. We should spend no more time worrying about the blame and just make sure that we spend our time making sure no projects are closing now that don't have the adequate resources to meet their mission.
Thanks, Traci. Kathy, let's come back to you. And I think you've covered this in part, but I want to sort of formulate this in this way for you to respond. It says, while we are no longer seeing a significant rises in interest rates, we've seen some leveling, maybe even some leveling or drop in terms of construction costs. We're continuing to see escalation in operating costs, as we've talked about, with little or no ability to move rents. Given that those are conditions to our funding sources, that's just by the tax code or just conditions to those dollars. What are you seeing now on current projects, and what should we expect to see in terms of credit and underwriting standards, primarily from commercial banks, but maybe other alternative funders?
Yeah, let me say some more towards this. I didn't bring my notes and I should have. When we are now underwriting projects, you may give me a portfolio or a pro forma that says 2% revenue increases, 3% expense increases, 5 or 7%. Sometimes I'll see vacancy levels. I am not underwriting my perm debt to that. I'm just not. I am putting in more room because that is the reality. Those deals that I have and that other commercial lenders have that are have been coming out of conversion or have been converting, you have seen lenders who are saying, no, it doesn't support this much debt anymore. Even though we're committed at this interest rate, this is the level of debt that can be supported. That's real. That happened, and it's going to be happening, I think, for another year. Just by how we underwrote and the long construction period and the delays in lease up and as you said, paying attention to lease up, construction loans, if you have a 6-month delay, that puts you so far behind because there's so much usually floating rate interest expense that then isn't there for the project once it's online and going. So all of that, you are seeing more conservatism in the level of debt that we can underwrite to. And I think that's just, and we are also really doing a lot of due diligence about the sponsor. Whereas before, we would look at the project, and if the project worked, we did it. Now we are looking to the depth of capacity of the sponsor to support if something doesn't happen like we're thinking it's going to happen.
Great, thanks. Ty, would you like to add to that in terms of what you're seeing at OHCS in terms of levels of senior debt?
Yeah, generally on the senior debt side, I mean, the capital stack is pretty much, it's kind of hovering around, 30 to 40%. We haven't seen a deal higher than that. So, yeah, and we're seeing more conservative underwriting, more pledges for additional collateral, and just more scrutiny from a permanent lenders, but also from the tax credit investor side.
More gap.
Yeah, more gap.
Great, terrific. Well, obviously, one of the reasons why we have lower debt capacity is these operating costs that we've referred to. Kelly, I'd like to turn it back to you and have you talk a little bit about your experience. You mentioned property and casualty coverage, but I know you've got some really positive lessons learned in terms of how you've navigated that relatively recently at Housing Works.
Well, I don't know. I mean, it was just a reaction, I guess. You had to sink or swim, right? So what we just got really active and just started calling different agents and shopping around and giving them our portfolio information and saying, we need insurance. And luckily, we had some luck with a couple agents that took on a good number of our properties. Some of ours are still at the risk pool, but we had pulled some out when we were seeing, 30 and 40% increases, and had to start shopping. The properties just couldn't afford that kind of an increase in our insurance bill. And we had one carrier that, I think I had mentioned this, that just canceled, said they were no longer going to do affordable in Oregon. And so we were, a month, 2 months before our expiration date, we're scattering to find insurance. And so we did have to place with a risk pool over in like Carolina, and it was really expensive, but luckily within a couple months we were able to find another carrier to take those on. And it'd be interesting to know what other people are experiencing from that. We had a couple carriers that told us they wouldn't cover a property because we had a Head Start classroom program in the property. We had a Boys and Girls Club at another property, and so they refused to cover that one. I guess they just thought it was too much risk. So it's just, I think it's just being really proactive and just trying to find out as soon as you can if your insurance company is going to renew or not, and at what rate they're going to renew, and then just start shopping around and comparison shopping. And we had really good luck with State Farm and American Family.
Okay, I'm going to say this out loud. Kathy, most of us are, as you mentioned, I think most of us are familiar with the crossover analysis of 2% annual rent increase, 3% annual operating cost increase, traditionally meaning that projects get through construction and lease up and stabilization, and they bump along happily for until year 15 or so, or somewhere 15, 18, 20, and then they come in and they get recapitalized and we move from there. Given the current environment without significant new public operating subsidies, are we accelerating toward a recapitalization cliff or something more?
Yes. And the thing about cliffs it's only a problem if you don't realize it's coming. So I think that I am seeing some positive things, okay? The first positive thing is that there is an openness to more preservation funding. And we have an asset management issue of one of the things that, that the sponsors will do is they'll defer maintenance. And so what's the worst case is you are at year 15, you have a tired property, and if you can't get the preservation funding, then it's a real issue trying to refinance. Right now, there's some extend and pretend going on, but we need to do something more. And I think that some of that funding is coming, which is good. Then also, I think another really positive thing is we can use OAHTCs, and we need to renew them. And that is something we're seeing more happen, or more openness to, because that 4% interest savings is huge. And once that's gone, trying to refinance that senior debt that's there, how do you do it when the interest rate jumps? So I think that's a positive. But you have to realize what's coming. And I can't, that's one of the reasons why I say we need to have conversations about your whole portfolio. And it's not looking at what's refinancing next year. It's what's refinancing in 4 years or 5 years, and how do we get that property to be ready for a refinancing and restructuring.
Great, thanks, Kathy. We're just about used up our time here, but just in wrapping up here, I mean, I know we're all, this is a great room of people who are committed to the principle that everybody deserves a decent, safe, affordable, a place to live. It's such a privilege to practice law and be part of this with all of you. And I mean that sincerely, to see projects get built, homes furnished, support provided to people in our community across the state. And it's been really exciting. I've been doing this 20-something years since I had the good sense to move back home to Oregon, and to see projects in communities that we just hadn't seen them for a very long time. And so everybody leaning in and everybody in this room deserves credit for that. So with that in mind, that we're all committed, we want to do the right thing. We want to see these public resources used as good stewards, maximizing their effectiveness and those things. Traci, I'm going to ask you to tell us what we should be advocating for in the public sector to protect existing portfolios and keep sponsor organizations viable. And then Ty, I'm going to leave it to you to do the wrap-up.
Thanks, Mike. So see my call out for asset management before. And I think using this information that we're all learning, in addition to asset management fees above the line, to look at what real, to Kathy's point, what do we need to adjust our underwriting standards to? Boring, but I know there's a bunch of spreadsheet jockeys in here, so you'll rise to that challenge. There is money in the OHCS agency request budget to support preservation of these assets, both for financial and physical needs, to support organizations that have been carrying these assets for all of us in the public for the last 5+ years. So right now, write it down, set aside some of your time in the first half of 2025, hook up with the Housing Alliance and get to Salem and support the OHCS budget request for these items in particular, of course, the whole budget, but these are the items that we're talking about today. You all live in a legislator's district. Most of you probably have housing in a legislator's district. And you know, those units are what we tend to talk about, but we as many frontline staff know that loving our neighbors, who are also in this case the people who live in our buildings, means respecting them in their homes. And that's what we can share from the heart to our legislators and to our peers, that by taking care of these places, we are taking care of each other, which is the thing that actually matters.
Yeah, just following up, that was awesome. So yes, definitely get to Salem. Ike Box is a great coffee shop in Salem. If you ever need recommendations on where to get coffee, there's a coffee shop right next to Capitol called Ike Box. Highly recommend it. But just to close, yeah, there's our agency request budget includes a number of funding for preservation funding for restricted housing. I think we're asking for about a little over 350 million. Operational support and system improvements, we're looking at close to a little over 64 million. Parks, proposing parks, we've got and asked for about 25 million. Insurance, we've been talking about insurance a lot. We've got a request out for offset insurance costs offset, about $10 million. Going to be looking for acronyms for that one, so just feel free to reach out on that. And culturally responsive property management, $3 million. Always welcome for acronyms on that too. So, in closing, yeah, we definitely acknowledge that these funding requests won't solve all the issues that you folks are seeing, but hopefully it helps in that regard. So, thanks.
I trust this was not gloom and doom, that there were some very practical advice here for everyone. Great takeaways, and just personal thanks, and I hope you all join me in thanking Traci, Kathy, Ty, and Kelly for joining us on the panel today. So thank you.
Also, just to have the last word, I'm not giving up, and you shouldn't give up either. This is way too important. We are going to find the solutions, and we're going to stay at the table until we got them. And I think everyone on this panel is in that house, as are all of you. So while I was doom and gloom, this too shall pass, and we will be to better times.
Well said.
Yeah, I wanted to let folks know there's some sandwiches left. If you want to grab a sandwich, take it home. I'd rather not see them go to waste out on the buffet line. Thanks.
Obstacles ahead, they don't disappear if you stay trapped inside your head. So get on that and face yourself. Get up now. Yourself.